Good morning and welcome to the Weekly Insights by John Plassard with Cité Gestion. The recent decline in oil prices is probably one of the most significant macroeconomic developments of the past few weeks. After surging on the back of geopolitical tensions in the Middle East, crude oil has fallen back below $70 per barrel as shipping traffic through the Strait of Hormuz gradually normalizes and major Gulf producers ramp up exports. If this trend continues over the coming months, its implications could extend far beyond simply lowering prices at the pump. The first and most obvious impact concerns inflation. Energy remains one of the most volatile components of consumer price indices, and its sharp increase was a major driver of the recent rebound in US inflation. Persistently lower oil prices should gradually ease these pressures, helping inflation moderate during the second half of the year. This matters because energy costs also feed into transportation, logistics, manufacturing, and the prices of a broad range of consumer goods. The second implication is for economic growth. Lower energy prices effectively act as a tax cut for households. As consumers spend less on fuel, more disposable income becomes available for discretionary spending. Companies also stand to benefit, particularly in energy-intensive sectors such as transportation, manufacturing, and chemicals, where lower input costs should support margins and profitability. This shift has also important implications for monetary policy. As inflationary pressures ease, central banks gain greater flexibility to keep interest rates unchanged or adopt a less restrictive stance. Although the Federal Reserve is likely to remain cautious, given that core inflation remains elevated, lower oil prices reduce the probability of additional monetary tightening, a development generally supportive for risk assets. Finally, equity markets could continue to benefit from the broadening of market leadership that has emerged in recent weeks. After several months dominated by large-cap technology stocks, an environment characterized by lower oil prices, easing inflation, and resilient economic growth typically favors cyclical sectors, small and mid-cap companies, industrials, consumer discretionary stocks, and selected financials. In other words, the decline in oil prices is not simply good news for consumers. It could also reshape market dynamics by supporting a broader, more fundamentally driven equity rally. Thank you very much. Have a great week. Stay safe and keep on winning.